Today on Forbes, thwarted by regulators, vindicated by Wall Street. Design startup Figma's CEO is now a billionaire. When staff at San Francisco-based design startup Figma returned from the Christmas holiday in January 2024, they were met with sobering news. A $20 billion takeover by Adobe, which had been stuck in 15 months of regulatory purgatory, had fallen apart amid antitrust concerns. In the wake of that news, co-founder and CEO Dylan Field pushed the reset button for the startup that aims to be the Google Docs for design. Figma slashed its internal valuation to just $10 billion and offered employees a voluntary exit package of 3 months severance. Only around 4% of the company's 1,300 employees took the buyout. The move, insiders and investors say, was meant to anchor the company and prepare it for the long-term future as an independent startup. Figma investor Mamoun Hamid, a partner at venture capital firm Kleiner Perkins, says, quote, "The net effect was that you had a lot of extremely motivated folks who have been working relentlessly to deliver new products." Nearly 18 months later, Field's gamble paid off. Figma and its investors were set to raise $1.2 billion yesterday, Thursday, by selling shares to the public at a more than $19 billion valuation on a fully diluted basis, including options and other equity awards outstanding. The tech IPO is among the 5 biggest in its sector this year. One of the biggest winners of that listing is Field himself. At Thursday's IPO price, he is now worth an estimated $1.8 billion, but that may only be the first chapter of his payout. Over the next 10 years, the 33-year-old could unlock additional stock currently worth $1.3 billion at the IPO price, before taxes, between the compensation plans awarded to him in 2021 and 2025, if he remains with Figma and the company's stock price quadruples to $130 per share. Adobe had offered him a similarly historic retention package. The structure reflects a trend of aggressive long-term incentive plans akin to Elon Musk's $56 billion Tesla moonshot grant, which a Delaware court voided in January 2024 after ruling that the process underlying the award was not fair due to Musk's control over the board. Musk has appealed the ruling. Field might have taken Figma public, but he still exercises a huge amount of control over the startup he co-founded in 2013. The terms of the initial public offering give Field the right to vote his co-founder Evan Wallace's shares, worth nearly $900 million at the IPO price. Field and Wallace will own 99% of Figma's Class B shares, which carry 15 times as many votes as the Class A shares held by other investors. All told, that gives Field, a Forbes 30 Under 30 alum, control of around 74% of the company's voting rights, including nearly 26% tied to his former Brown University classmate Wallace's shares. Wallace would already be worth an estimated $1.3 billion himself, based on the IPO price, had he not donated a third of his shares in June to the nonprofit Marin Community Foundation, which works to fight homelessness, according to Axios. Wallace, who previously served as Figma's chief technology officer, left the company in 2021. Field, Wallace, and Figma declined to comment. The listing marks a remarkable comeback for Figma from the collapse of its $20 billion takeover by Adobe in 2023. At the time, Adobe's CEO, Shantanu Narayan, branded the deal as, quote, transformational for the publisher of Photoshop, Premiere Pro, and InDesign. Adobe investors, however, balked at paying a sum that valued Figma at twice its last valuation and at around 50 times the startup's $400 million of revenue. The deal was also met with concern by antitrust regulators in the United States, the United Kingdom, and Europe, not to mention Figma fans, many of whom had bailed on Adobe's own costly tools. The acquisition, which was first announced in September 2022, was ultimately called off in late December 2023 after the British antitrust watchdog warned that the deal could reduce competition for design software. For full coverage, check out Ian Martin's piece on Forbes.com. This is Kieran Meadows from Forbes. Thanks for tuning in.